Welcome to the Economy and Politics Show. I'm Ottoabasi Abasiekong. Recently, Proshare, a specialized financial information practice firm, presented the third edition of its flagship Tier 1 Banks report. It has generated much discussion in the financial and investment community, as it comes at a time the Nigerian banks are bracing for the 2024 recapitalization exercise, announced by the Central Bank of Nigeria on March 27, 2024. This edition of the show will discuss evaluating Tier 1 banks in Nigeria, the quest for sustainable financial institutions. And my guest joining me in the studio is Mr. Tosin Ige, Head of Research, Proshare. It's great to have you in the program, Mr. Tosin Ige.
Thank you for having me.
Very well. Now, the Proshare Banking Strength Index for the full year 2023 revealed Access Corporation, Zenith Bank, EcoBank National Incorporated, or we call ETI, United Bank for Africa, and GT Corporation, that's Guaranty Trust Corporation, retained their Tier 1 position. This reinforced the AfriInvest-inspired FUGAS. I like that acronym, FUGAS. But can you provide further insights into the metrics for the class of 2024 and the revised methodology used this time for the Tier 1 banks?
Okay. Thank you once again for having me.
Yes.
Good to be on your show.
Yeah.
And for the metrics this year, as you said, the industry has a matrix that, of course, and the classification that bettered the FUGAS. And this is actually akin to the systemically important bank classification by the regulator. Both metrics actually uses the traditional banking industry metrics, talk about the total assets, the deposits, the credit, as well as the liquidity. And of course, they come with a cutoff point within which either it's a one or SIB, as the case may be, or not. But one of those things we argue is that when you look at the industry based on that tier classification on, they are based on fixed value that shows the cutoff, and for the regulator, they are based on certain ratios. So our point is that whereas this model may recognize banks that are truly influential to the financial system, they may actually undermine the dynamics, the strength, as well as the resilience of this bank. So that's why we set out with a model that is rather dynamic, that represents the efficiency of this bank, as well as also capture the banking evolution. Don't forget, in our previous edition, we have said banks are going in extinct, but banking is still dynamic. We needed a methodology that actually captures, that is fit for every purpose. And so that bettered our Proshare Bank Strength Index. And for this, the current year under review, what we did was that we classified the metrics broadly into 7. And that talks about the capital, the assets, the risk, the efficiency, profitability, digital banking, as well as the governance. Now, don't forget I said we're looking at the methodology being fit for every purpose, dynamics. And so
I like that, fit for purpose methodology.
Exactly. So that is captured in capital, in the capitalization. You remember, you mentioned it now that this is the
season of recapitalization
for banks. So that is captured on the capital, where we have to use the share capital and share premium. Again, we excluded the retained earning because the CBN
has given that guidelines.
Said that retained earning of most of these banks are encumbered. So we only use the share capital and share premium, and of course other issues around the capital, we capture it with the capital adequacy ratio. For assets, we also use the asset size, and of course, how is this asset deployed? We look at the loan asset as well as how you are growing the assets. And in terms of risk, we use, of course, the quality of loan, the MPLR, and we use your cost of risk, which of course, the lower the better. And in terms of profitability, we use earning growth, and then we also use the net interest income. For the digital income, of course, we use the ratio of digital income in the gross earning. And then, of course, for efficiency, yes, that was what I was trying to remember. For efficiency, we use the cost to income, which again the lower the better. So, and then lastly, we use the governance. You will agree with me?
Governance is very critical.
Some banks
Yeah.
go down because of their governance
Yeah.
issues. So these are the metrics which are basically improvement from our last model in order to fit the current purpose and the current dynamics of bank.
I like the methodology and the fact that it's fit for purpose, and those 7 metrics clearly are very critical for not just stakeholders, investors, the whole community to understand how the banks are evolving.
Banking ecosystem.
Yes, banking ecosystem.
The regulatory aspect, the banking operation, as well as the customer side of it.
Broad-based. I like that. Now, this report, like I said earlier, comes at a time where we're having the recapitalization exercise, 2024 to 2026. The Central Bank of Nigeria, announced that on 27th of March 2024. There's a quote from this report, like that quote. It says, with higher capital levels, banks must use the large amount of cash available to improve shareholder returns and customer experiences. I would like you to elaborate further on this. I like that quote.
Yes, we also like the quote because let's not forget that banks are also business and they are there to actually return value to shareholder. And as such, we've examined the recapitalization program that is ongoing, and whichever side you want to look at it, we think it will actually return value to shareholders as well as improve customer experience. Traditionally, banks don't lend their money, but our sense is that if history will repeat itself, don't forget the last recapitalization effort you made mention of in 2005, that coincided with the universal banking model of many of these banks. And so because of the availability of those subsidiaries, so even though the capital was raised from 2 billion to 25 billion, we'll see many of them investing in their subsidiary. And of course, that investment, depending on how viable it is, it had a high return to shareholders. And of course, customers are also better for it. But of course, there are downside risks to it. But let me just leave that for now. So on that side, there is, we anticipate high return to shareholder. But even if you want to flip the argument, and we'll see a situation where bank actually lend this morning to the real sector. One of those things we feel will happen is that there is loan portfolio diversification and loan portfolio growth. And again, depending on how they are able to manage the quality of this loan, definitely we expect returns to the shareholder. And of course, broadly, the economy will also benefit because we are looking at a situation where in lending, banks are lending to finance real sector activities in the manufacturing, in the distribution, and of course, this projects us towards the growth of the economy that the CBN actually, in its wisdom, places the current recapitalization effort on. So whichever way you want to look at it, we actually feel that there will be return to shareholders' value and customer experience.
Very importantly, everything that the banks are doing, like you said, as a business, the end point is that value to shareholders and of course sustainability. You mentioned risk, and risk is very critical. Now, so risk management, banking system sustainability is very vital. Like you said, there was the 2004, I think 2006 capitalization, this Professor Chukwuma Soludo era, and then we saw the banks move from 2 to 25 billion naira, and then came this challenge of asset and liability management, which the era of then Central Bank Governor Lamido Sanusi, now Emir Mohammed Sanusi II, had to wield the big stick, and several banks had to be go through that management. So my big question is, when you look at the whole issue of the challenge of the past, post-recapitalization exercise, and the need for asset and liability management. You wrote in the report, Proshare highlighted even the challenges of Silicon Valley, in the Silicon Bank, that's in US, Silicon Valley Bank. They had issues around ALM. So it's a global phenomenon too. How can banks effectively manage their ALMs with the lessons of post-2004, 2006 recapitalization exercise?
So thank you very much for that question. As you said, it's one of those issues we identify in the report. And then we sense that banks don't joke with the ALM, that's the asset and liability management, especially with the lessons that the global economy learned from, as you said, the likes of
Silicon Valley Bank.
Valley banks. So one of those things, if we step back, what we feel is that there are two sides to it, in the sense that if we go forward to say the asset and liability management of bank, don't forget, banks in themselves, they understand that the recapitalization effort may add a layer to their risk, in terms of the fact that when the last recapitalization happened, don't forget I said there was a risk to it. We saw banks like Afribank and Oceanic actually go down, maybe I think 5 or 6 years after the recapitalization effort. So there are also risks to it. You may succeed in raising the capital, but what actually the post-capitalization is also important, because you won't, as a bank, you want to make money with your money. You may not want the capital to be idle. So where do you fix those the capital is one thing. So there are an additional layer of risk to the ALM in terms of this recapitalization effort. But on the other side too, which is positive anyway, the recapitalization efforts actually provide a cushion for all the ALM activities of bank, in the sense that whether you are dealing with your liquidity management, you can invest your money. If you don't want to loan, even if you want to loan, you can actually loan to those ventures who you feel that lower capital would have been risky. But with higher capital now, you can actually lend to those guys, because don't forget, you have a capital cushion to weather any losses from that segment. And again, you can also invest also in off-balance sheets activities, which you may have been holding back as a bank before. You may be holding back to say we have lower capital before. So this provide that cushion for it. So I'm saying there are two sides to it. That there's a cushion that the recapitalization efforts provide, but on the other hand, it also had a layer of risk if it is not properly managed. So that lesson in history from the last recapitalization effort is what I think we need to strengthen. And I think I must say again that one of those things we also recognize in the report is that this recapitalization effort also provide the buffer for banks to actually invest in R&D. So we should see innovative products being turned out from the banking, from the R&D investment. So that's one of those things we really feel that. That's why I said whichever way you look at it, we are positive on this recapitalization effort. Yes, the economy as a whole may not have the absorptive capacity for it. Perhaps some will argue otherwise, but from the banking sector perspective, it's actually positive, because we know we have seen the trajectory with which these banks are growing in the past. And so we expect that this recapitalization will actually support that, that trend for the banking industry.
Very interesting. Now you spoke about the economy. The central bank governor, Mr. Yemi Cardoso, last year at the Challenge of Bankers of Nigeria annual dinner said recapitalization was critical to supporting Nigeria's ambition and that ambition to attain a $1 trillion economy by 2030. Now, the report has noted that banks raising that equity is no guarantee for economic growth and development. Very interesting. But what is the proposition to the economic management team? Just recently, the president inaugurated the Presidential Economic Council and has laid out the economic stabilization plan. The banking system will be critical in that area, where they can finance and what they can do to support that. So what is the proposition to the economic management team and, of course, the leadership in the banking industry?
Okay, so I think I will again take it in two folds. And let me say the first one is what we've talked about, but from the economic management team, which of course feed into the banking regulator, we only feel that as much as there's a watch on the process of this recapitalization, there should be a watch also on the post recapitalization. So maybe we need to tighten the prudential guidelines, properly, such that we won't have what we recorded of, as I said, those other banks that went down the drain. So that we won't have that kind of experience, we need to maybe tighten the prudential guideline, and of course encourage banks to place prudency above short-term returns, so that that is safe. And on the other hand, as I said, we argue that using banks' equity capital as driver of growth is actually not just a matter of money, but it requires a coordinated effort from both the public and the private sector players. And one of those things why we are arguing this is that we have, at Proshare, have always argued that there is the need for the whole of government approach to managing our system. So regardless of where you're talking about, whether the financial aspect or the real sector aspect, we need a whole of government. Now, let me give us an instance. Now, if we are raising capital, we believe in the wisdom of the CBN. They've said they intend that this will bring in fresh capital, perhaps even foreign capital. Now, these foreign investors are looking at your system, the play of businesses in your system. Now, they may not want to invest in a system where they know that the security issues has not been dealt with. Do you understand? So they may also be looking at the tax regime in the system. How does it operate? So that's why we believe there is always the need for coordination between both the public and the private, and from the public, the fiscal and the monetary. Yes, I think just recently the president launched that Presidential Economic Coordination Council. So hopefully this will find a way to, help in that regard. But really, from the government, from the public sector itself, we need to actually start from them, the coordination, not to undermine the efficiency or the independence of the monetary authority, but just a coordination such that actions that are being taken by the monetary authority are not being undermined by the other leg of it, which is the fiscal authority. So let that coordination be there. And if we have that coordination, as we said, we are positive on how this will actually help to, facilitate that $1 trillion economy that we hope to achieve as a nation.
Yeah, very, very insightful conversation, Mr. Tosin Ige. We could go on and on, but we just have to cut it out here. But thank you very much, Mr. Tosin Ige, the head of research Proshare. Very insightful conversation on the recent third edition reports, the flagship report of Proshare, Tier 1 Banks report that looked at evaluating Tier 1 banks and, of course, the making of the class of 2024. Thank you for that insightful conversation. Thank you. Thank you very much. That was a very interesting conversation, Economy and Politics show, looking at evaluating Tier 1 banks in Nigeria, the quest for sustainable financial institutions. To our viewers, if you want to get further insights on this conversation, especially the third edition of the Tier 1 Banks report, a flagship report from Proshare, visit the website displayed on the screen and follow our social media platforms to engage further. Till we come your way again, enrich yourself with the knowledge of socioeconomic developments around you, because it's the wise thing to do. I'm Ottoabasi Abasiekong. Thank you for watching, and bye for now.